Thank you, James. So let's couple of slides just on the trust and how we operate to set a scene, and for some of those listeners who maybe don't know so much about us, and then I'll touch on my outlook and how I'm seeing markets. I'm sure there'll be some questions on that, and then finish up with our positioning and how we're sort of currently structured. So let's talk about bankers. I mean, core principles. We have two objectives. Most trusts have a single one about a benchmark, and we're trying to obviously outperform a benchmark of global equities, but we're also trying to grow the dividend above inflation. And so that's important, I think, for a lot of our investors who rely on the income and the growth in the income. We're 58 years, fractionally behind City of London by about 4 months in terms of that long-term record, and ahead of the rest of the bunch. So, 58 years of annual increases in the dividend. So, very powerful statement of why investment trusts are really good for income and income generation. We're focused on a sort of portfolio of about 100 stocks, but really set into 4 regions. So we're trying to cover the whole world. We can invest anywhere we want. We've got licenses in pretty much every market, and we've split the world geographically. But we talk as a team about the stocks we own, and we can sort of overweight one in one region because it gives better value or better opportunities. But about 100 names. We cut this right down. So some of us may have seen me a year or two ago. We used to hold more. We had a big, deep review last year and decided to simplify, really, I think is the best way of thinking about it, to follow really where we had the greatest conviction to try and put more of the capital into those investments, and so cut the tail quite dramatically in the portfolio. And I think, apart from sort of a tricky time around the election back in November 24, when Trump got in, and global equities, there were some rather extreme price moves in some stocks, which have sort of settled down this year. We're roughly ahead of the benchmark just about year to date, and so I think it is beginning to work quite nicely, that increased focus. I work for a company called Janus Henderson, who have the management contract for this trust and have held it since the 1970s. So a long-term relationship there, and very much what we believe in. We're a big firm listed in New York. A lot of analysts, sort of 200 plus investment people on the equities side alone, and we have local experts. Really, our analysts are based predominantly in the regions. So although the PMs, some of them, Junichi, my Japanese manager, is in Tokyo. We really are drawing on local expertise in these markets. So the ability to get to meet companies and know their markets well. And that therefore gives us the flexibility to shift around a little bit between value and growth. I think we've moved a little bit more value in international markets, continuing really generally with a growth tilt in the US, and that's been delivering reasonable returns. And then finally, low costs. The management fee, the all-in cost is sort of 0.51 there, with all charges in there, and the management fee is a tiered one. So as we grow, the fee should fall, hopefully, and low cost debt. So we refinance all our debt through the last sort of 7 or 8 years. So our debt extends out to 2045, so another 20 years before the last one retires, but an overall cost of 2.7%. So we're not relying on very expensive short-term borrowing facilities. The team itself, here it is. Myself, I've been managing this for since 2003. So very much been enjoying managing this trust over those years. And then I've been joined recently by Richard Clode, who's a colleague I've worked with really quite closely for about 7 or 8 years. He's been with us for nearly 10 at Janus Henderson. And so I know him very well. He has a technology background, which I think is going to be really important for the next 5 or 10 years of investing, in my mind. I think particularly, I'll talk about it later and we can talk about it in questions, but it's about the adoption of AI and how really the new technologies are going to filter through all companies. That I think really is exciting about what Richard brings. So not just his expertise in the current big IT companies, but really how they're going to adopt technology throughout different industries. So Graham, I'm really pleased he's come and joined me. A lot of expertise, a lot of experience, as you can see there. A very fine fund manager. So the rest of us, average of sort of 25 years of experience there. So again, a very experienced investment team. but sitting on top of some sort of 70, 80 analysts that we have around the world who really are spending their entire days looking at stocks and trying to think about them deeply. So as a team, we work very closely. We try not to overlap in too many stocks, but really try and make sure we're consistent, talking about themes we see in markets and investment ideas and how they affect the different companies and the different regions we manage. So let's move on to sort of talking a little bit more about how we see the world. And I think there's been a lot of challenges in markets, and I think reflecting a little bit on what's been going on. I think two things really have worried investors, but actually markets have climbed that worry, and have actually, from a market point of view, sort of put it aside. The first one is obviously tariffs here. So on the right is the US effective tariff rates, and we can see that spike. We remember Liberation Day with Trump with his board of 30-40% on a lot of import goods. We're not anywhere near that. Deals have been done sort of in the 10 to 15 to 20% range, and there's a lot of offsets, and we're hearing more, and we probably don't know all of them, and there will be more to come, I think, of goods where they just recognize cocoa, coffee, all sorts of food stocks that aren't grown in America, but they enjoy consuming. So I think there'll be lots of offsets and concessions. So maybe this ends up at 15%, but it is manageable. The companies we're talking to are saying, look, we take a bit of a pain, and the importer takes a bit of pain, but generally this is manageable and isn't affecting sales materially. On the left are the inflation worries. So these are the inflation rates. So I think look maybe at the green line, which is the sort of core goods, which you expect some of that, less foods and energy. It has risen a little bit, but it's manageable. It's sort of still under 2%, and the core levels, again, flicked up a little bit in the last few months, but they look, again, very manageable. Rents are falling. So I think I've got a slide in a minute, we'll look at, how interest rate cuts may be coming. But I think, it isn't the big spike. It isn't the 4 or 5% with rates having to go up that everybody worried about. So I think we're transitioning through the worries about tariffs. And then the other worry is really about investment, sort of a bubble, AI spending, and really whether it's a deeper question about the returns, but really whether this spending is too much. So this is an interesting graph looking at the line there rising. The single line is the cash flow, operating cash flow of these hyperscalers. So the big US companies that are basically investing the majority of the money into the AI and data center expansion. Their cash flow has been inflecting upwards as they're very successful businesses. Companies like Amazon sort of winding up the margins and the prices they're charging, and therefore the capex is going up, to Microsoft growing very strongly in cloud services. So basically they've been growing cash flow, and therefore the capex, that sort of green box there, it's been expanding very rapidly and continues to accelerate, but it's within the envelope, in my mind, of their cash flow. They're not cash flow negative yet. They're still buying back stock, as you can see the browner line there, and they're still paying dividends. So I think still manageable. It is accelerating. So I think we're in a boom, not a bubble. And bubbles are characterized by excessive leverage, excessive IPOs at ridiculous prices, and these sort of elements. Now, until the AI boom becomes sort of heavily leveraged and debt funded, which I just, it will do one day, but it isn't at the moment. So I think at the moment, very manageable. It's managing it within their cash flow. And these businesses are very profitable and are lower ratings actually than the peak. They're half the ratings that we had in the dot-com boom. If you look at price to EBITDA multiples or PE, traditional PE multiples. So I think still a manageable phase of expansion and interesting opportunities. If we look for next year, so look at it more our outlook, I'm reasonably positive about next year. I think this year has been challenging from a macro point of view. Companies we meet have said, look, we have slowed investment, we have slowed hirings because we just wanted to see how some of these issues transpire and move forward. And I think it'll settle down into 26 with the benefits of some quite big things. In America, we've got tax giveaways from Trump's big, beautiful budget, both to consumers and corporates will be saving tax. And then the tariff situation will move through as it does, sort of one-off adjustment in price. So you see here on the left chart, the GDP growth expectations on the left of the line, which is historic to some extent, lots of volatility there. So quarter and quarter, choppy and very difficult for companies to be managing those variations in demand. As we look forward, these are the UBS forecasts, you begin to see it settling down a little bit, particularly with the US sort of matching European growth, but sort of 0.5% per annum for a quarter, so 2% per annum. It's quite a nice stable background with what hopes some interest rate cuts as well. On the right is looking again just at US earnings against European earnings, and it's been the key reason why US market has continued to outperform. Again, it's been a bit choppy in the last few years through COVID, but I think you can see on the far right, that green line, the trailing earnings relative between the US and Europe is beginning to stretch upwards again. So one hopes German expansion, fiscal expansion comes through, but I still think the US is the place to be hunting for a lot of your stocks. I mentioned finally that I think we will see some rate cuts next year. So again, the left-hand chart is showing you how much the market is pricing in interest rate cuts. So roughly another 2 quarter point cuts for the UK and 3 quarter point cuts for the US. I think, a bit tricky in December whether the Bank of England cuts. It might do. I think the Fed will probably skip December and cut in January. But I think the pressure then rises on both central banks really to be cutting next year into some slightly better inflation numbers in my mind. So I wouldn't be surprised if we get all the way down to a 3 in front of the interest rate, both here in the UK and in America. So I think that's again we build a bullish for equities and then the market. Finally, and sort of through aspects, the challenges often are, look, isn't it very expensive equity market? It is more expensive than historical. And you can see that the PE ratio there has been rising in the last few years as this AI investment spending is supporting the economy and growing earnings. But I would look at the blue line, which is the margins, operating margins for US companies in the S&P 500. It is still rising. So margins are going up, companies are more profitable, and you therefore pay a higher price for that, in my mind. It justifies the higher price because they are better quality businesses and earning better returns on their invested capital. And I think this continues to go up. I think you'll find, again, say some of the discounts in the offsetting taxes, investment spending, some of the tariff impacts will bring for US companies more manufacturing onshore and more volumes against some of their competitors. So again, more reasons I think next year to continue on the whole to sort of focus on some of these US names. Not to the extent of all markets. I think there's still Japan is another area I favor and have favored for a while. It's done quite well. It's held up reasonably well through this year. Again, sorry for all the lots of lines. The one I wanted to focus on was on the left, which is Japanese compensation. So wage growth is the green line, has been rising and is roughly 4%. Doesn't sound a huge lot, but when it's been a 20-year stagnation in the economy, to get 4% increase in wages is important and is helping offset some of the inflation in that market. But it is driving consumption. So you're also seeing the red line there going up, which is consumption in Japan. Again, that's all helping the stock market in my mind. So again, I think some quite interesting trends going on there. So how are we positioned? I think one of our key themes has been predominantly financials and particularly banks. I think there's lots of reasons in here. So first of all, that they were very cheap. So on the left is just look at European banks PE relative, so the price relative to the market. If we go all the way back to the start of the GFC, the financial crisis, they were sort of roughly trading in line with the market. It's lost all of that premium, almost trading at half the market valuation as it was building capital, reforming. And really, I think from that level, to my mind, we're at a position where capital is adequate now. It doesn't need to be rebuilt. If anything, we may see some deregulation, reduced capital requirements, which again would be supporting growth. So I think growth has picked up. Interest rates have risen. which means returns on deposits are rising, the spread is rising for banks. So lots of positives in here. But on top of that, again, we're seeing investment borrowings begin to improve a little bit. So loan growth is improving. And I think finally, I think this is a sector, financials in aggregate is likely to be probably the early beneficiaries of AI adoption in terms of productivity and improvements in cost and margins. So I think this is probably, if you said which sectors taking on AI quickest and adopting, it is financials, starting with the big banks who obviously have more capital and more investment to spend on AI. So as we look that trickle down, that diffusion, I suppose, of the AI investment, you're building data centers to cope with handling data and improving how you use your data. I think the financials are going to be one of the sectors that will see the benefits quicker. So another reason to own it. So when you look at our exposures there, that financials is our largest overweight position. Also provides very nice yield, which is always helps. We are sort of broadly in line with IT, so we're not hugely overweight. But within there, the key holdings are probably Amazon and Microsoft are our largest overweight positions in the sort of Mag 7 names. But we have a decent exposure to semiconductors and some of those hyperscalers that are building out the networks of data centers. So again, that we like that. We're quite underweight, I suppose, historically, the consumer. I still think in Western markets, there are pressures on consumers from price rises coming through. So again, an area we're sort of much more lower exposed than we have been historically. These figures are sort of September, as always. They have to get these presentations lined up. The October numbers are on the website, and they will show a little bit more investment into North America. The downturn we've seen in the past few weeks, we see as transitory. Markets don't go up forever; they do have pauses and pullbacks. But looking at the underlying earnings and talking to companies through the third quarter results that we're just sort of finishing up with, I think is a very positive message coming through about investment spending and the picture for next year. So with that, I might pause actually and let James maybe take some questions.
There we are. I am back. Very good. Thank you very much, Alex. It's very interesting. It is really interesting because it's sort of running slightly counter to a lot of the headlines. I mean, I was looking at that because a few people have been saying, oh, maybe you should start looking at consumer staples, and you're actually quite underweight that. So you're basically saying this pullback is temporary and it's not time to start running for the hills.
No, I just don't see, the big bits about, right, we're in a bubble, and it's going to crash imminently. And, I think some of the signs, the negatives, they say, well, look, there's a lot of cross holdings, everybody's investing in everybody else. That's a terrible sign, isn't it? I think when you think about it, if you were Nvidia with sales of 50 billion odd a quarter, and the amount of cash they've got, wouldn't you, help the supplier base, to continue to grow this out? Because if everybody if AI is the next sort of industrial revolution, then you want as much of this stuff to feed through, and they're not throwing it away because they'll sell these chips to somebody else. They're in huge shortfall. So they'll take the chips back if there is some corporate failure. But I still don't see it as a position. That chart, I think, is very powerful. The one that when you look at Microsoft and Amazon and Meta and all the big boys that are spending, they're doing it within their cash flow. They are not. There's another graph I've got, if I just jump through, sure, which is quite an interesting one, which is this one, which is basically capex of the technology sector against sales and then free cash flow. Now, I think sales is a slight misnomer. It depends on your margin. You can sell things at 90 cents to everybody, but in the pound, 90 cents to the dollar. But the blue line is the key one. The capex to your free cash flow is running at about 40%. It's on the right hand side. It was 78, odd% at the boom of the .com era. So we're not there yet. And I think, I do think the market is still going to see some very strong numbers come out of a lot of these names in the next year. And the consumer side, we are buying some actually. I mean, I've started a holding in Diageo. I'm, I think there's a few companies that are really hitting very low multiples, but I think it's early days to start nibbling rather than, getting yourself materially overweight in some of those consumer stocks.
It's fascinating. I mean, I suppose part of the reason why people have been nervous about AI is this end use case thing. Are you
Yeah.
using it at all yet in managing the money? Are you helping you doing research or anything? Is there anything going on within
Yeah.
Henderson?
So I think, yes, there is. So I think um, it's about the productivity. How can we improve things? So a lot of the jobs that I do that take me away from looking at stocks, writing reports, writing updates for people, a lot of that is beginning to do. And so we have systems that do all the attribution analysis. It just chunks it through. It knows what I own. It knows what I bought and sold, and it goes, right, here's your performance data. And I've just got that now at my fingertips. It chunks through corporate earnings figures. We again, through Bloomberg and other systems, we can quiz it with questions and say, tell me the inventory story here, and it just chunks it out. So I don't have to spend hours getting to page 52 of reports. So I think productivity gains. I'm spending more time, materially more time, looking at stocks than I was doing non-investment activities. And then for the business, again, we're hearing lots of great examples of how it is reducing time and allowing people to do actually productive tasks, whether it's filling out requests for information for clients or presentation writing and things like this. So there's no killer app yet,
Mm.
but I just think we're in the early days of how, freeing up people to actually focus on productive aspects of their jobs to grow their businesses is going to be the next phase.
Within the financials, you talked about banks, and are you worried that there's any kind of pressure on interest rate margins as interest rates come down, or are we not there yet?
So I think what you need to know is a lot of banks hedge this exposure, so they will, and they hedge it much longer than you think, so 3 or 4 years. And so so that leaks into your net interest margin or leaks out. And so in that respect, if you talk to particularly UK banks, they would say we've got still 2 years at reasonably good peak net interest margins before the rate cuts that we've just started to see begin to
Mm.
ease into those numbers. So I think you've got another couple of years before you'll really worry about if rates do go down as far as sort of a 2 in front of them, but they're not. I think they're going to slip down to maybe low 4s or a 3, because I think inflation is bubbling away everywhere. It's the genie that's out of the bottle, as it were. It's going to be very hard to get that under control. So I think it's in my forecast. It's in our numbers, our modelling. It's a slight degradation in the net interest margin, but on top of that is really, if you can get some
Yeah.
deregulation, some sensible deregulation. I'm not talking about going back to the wild days of massively leveraging balance sheets, but there's a lot of some aspects I think of that could be solved in there, and focusing on lending again. Lending growth is very low at the moment. Now, it should be in the sort of I think it should be double GDP. So we're talking sort of nominal GDP. It should be about 6 or 7% in the current market, and it's basically 2. So if that picks up on top of all the other things, you should see dividends as well continue to grow. So the dividends and buybacks is roughly sort of 10%
Mm.
of market cap at the moment, annualized. It's pretty impressive. So you're chunking away with that with underlying earnings growth. It's not difficult to get a 15% sort of total return story, if not 20% in these names,
And then outside
without
of
valuations going up.
and then outside of the banks, are you buying asset managers, insurance companies, that sort of anything else like that within financials?
Yeah, we still really like the card processing
Hmm.
names. So Amex is probably our biggest holding in that space. So we like that from a sort of also a travel point of view, but they seem to be winning a very nice game of accumulating new clients. It's an aspirational brand for a lot of people, and therefore they're growing their client base much quicker than their competitors. So we quite like the card processors. Again, the world is going ever more non-cash. So again, it suits them and the systems where they transact over. So probably that's the next biggest bit. And then after that, insurers, it's more tricky. We do own them, and we're starting to take some profits. I think they push price. They've had a challenging time because a lot of the costs of whether it's repairing cars or all sorts of things have been quite challenging, and they push price up. But I think you're beginning to sort of, I think, sense where those margins are likely. The difference between obviously what they're charging, what they have to do to repair things is beginning to crunch a little bit. So I think a little bit more worried about that area. So profit taking rather than net investing.
And second with sectors, what's the view on healthcare at the moment?
Here we go. Yeah, it's very mixed. Obviously we've seen quite a lot of volatility. The big names in there are the GLP-1 names. So Novo and Lilly have been had been the star performers. Novo stumbled this year for many reasons, and then Lilly had a big fall, but has just rallied again in the last month. So increasing volatility in that space is obviously, I think, primarily the Americans, quite understandably, say, why are we paying so much more for these drugs than they're being charged to other nations? So we're in a sort of funny phase where there's been a lot of price realization. I think we're getting to the end of that. So I think that's definitely, hopefully we as investors and the companies understand really what they're going to be charging for things in the next couple of years in many of their markets. And the tariffs, again, haven't turned out to be quite as painful. They can move production and they will invest more in the US. So I think it's settling down, but it's still quite volatile if you've got a good drug or a bad drug, or things don't work out for you in your new developments. So we prefer the medical supplies companies. So again, the consistency of those operations, and their rising wealth is meaning more people are having these operations globally. So growth in emerging markets is quite strong. But so these are knee operations, all sorts of eye surgery and things like that. So I think that's probably where you want to focus, and where we are a bit more focused. Some good names in the US again in that market. So healthcare is underweight, but underweight pharma against, and we've taken some profits in the Lilly rally that we've seen. That was our biggest holding. So.
Cool.
So it's still a bit mixed. It's not that great defensive sector. It's re-rated downwards. But again, if I'm right in saying, look, I think we're still in a relatively good growth phase of the market, it's going to lag.
Emerging markets. Do you have got much exposure to China within that Asia segment there?
Much lower than we've ever had for a long time, I think, really, for 15 years or something. The names that have done well are either some of the more speculative sort of technology names, or quite high yielding sort of big staples and defensive companies. And the reason they've done well is that the interest rates have just been slashed in China, and investors have been pushing lots of money into high yielding equities. And so they've been doing well, but not for any great reason, for profitability gains. So, and it's still an economy. We're sort of struggling to see great growth drivers. Again, the government supports a lot of industries, and they're exporting well. But again, those channels are getting ever tougher as I think, countries are rightly saying, we'll stop dumping goods in our markets. So I think it's pretty low. So China's about 1.5% or something, 2% of that Pan Asia. Not 2%, a quarter, I suppose.
Yeah.
So 2% of the whole portfolio, but we have been over 10 at previous times.
Okay, cool. Can you explain sort of the big picture thing about how you do manage gearing and cash, and where we are with that at the moment, please?
Yeah, so if you're obviously know Invest Trust well, we can borrow money from investors for long term. So loan stocks, these are called, or debentures, or the old sort of thing. So we've got three loan stocks running out to 2035 is the first one that's going to retire, and then out to 2045. We've got some euro debt and mainly sterling, and so the cost of those in aggregate is about 2.7%, but it's fixed, so it's quite nice. That's much lower than interest rates, and it's obviously saved us relative to borrowing from the bank, with a chunky margin over 4% base rates. So that's sort of fixed. Now, obviously, that's fine, unless your assets are collapsing and suddenly the leverage is very high. So that in total is about 9% of our assets. So our leverage, if we were fully invested, would be about 9% gearing. And so very manageable and about the right rate. I think if rates came down and I got another opportunity, it'd be nice to to go to about 12% of long-term borrowing. But I think 9's fine. The markets have gone up, and therefore the gearing's gone down. But we hold a little bit of cash against that, really for sort of essentially for working capital. And we are also buying back. We feel the discount's too low, so we're buying back some shares. So I need a little bit of money to manage the discount buyback, and taking opportunities where we see suddenly market dislocation. We don't want to sell something. We'd like to buy it out of cash. So at the moment, the gearing's about 6.5%. So it's about another two and a bit sitting. And that's earning, the base rate. So actually the cash is earning more than the cost of the leverage, which
That's
is a
good.
unique opportunity. So that's earning about 4% and 4.2 in a cash fund.
Great, thank you. And there was a question about the discount. So basically, it's buybacks is the best tool for managing that.
We think so. Yeah. I think there's lots of, we were on a premium in 20 as not far back ago, sort of 22, and we were on a reasonable premium before that. And it went out, slid out with all the other trusts in sort of 20, late 22 into 23. And I personally think it was a function of initially their interest rates rising. For noise, interest rates going up quite sharply, and investors pulling money to invest either in long gilts or cash deposits, and that's affected us, I think, as investment trust community. And then, recent year, let's be honest, government uncertainty on tax rates and whether you should be passing, cash to your children or taking capital gains. And one hopes next week's budget gives us some certainty. I doubt it will. Overhanging questions, but I think that's led again to people slightly artificially selling things to realize some capital gains. So I think the pressure there, we've narrowed that discount. It's sort of high single figures now, but it's I think it should be in single figures at worst. So we will buy back reasonably aggressively if it's beyond that. So I think it is the right tool for us at the moment.
Obviously, the UK market does look quite cheap relative to a lot of other developed markets. Is that reflected in the weighting? And what do you think the budget might do to that?
It is. Yeah, you need to sadly remember that when I started, I think UK was sort of nearly 15-20% of global markets, and it's about 4 or 5 at the moment. So it's really lost its way in that sense of its scale. But there are some great companies, and so we are about 6.5-7% of that, pan-European. About a third is UK, and yeah, there's some very good companies we see at good valuations. So we hold things like National Grid. We own NatWest Bank. It is the biggest, second largest bank holding is NatWest, which we still see some opportunities in. And then there's slightly smaller things like Cranswick, which we've owned for a long time. Pork, probably again very good, stable. It's never really issued any stock, and always just manages itself within its cash flow, and invests very heavily. So some smaller ones and some bigger ones, but within a portfolio of 100, you're limited to sort of 6 or 7 names in the UK. But
Yeah.
There are some opportunities, and we're overweight. Yeah.
Great. Okay. Thank you. I think we covered a lot of ground, and we are nudging up towards 12 o'clock. I was going to put that's the top 10 active positions, which is obviously kind of interesting. What's K?
So this is against the global benchmark, isn't it? Remember that KLA makes. So it's part of the semi space and semiconductors, and they make really the global leader in terms of testing of wafers. So as the wafer size gets ever smaller and smaller, we're talking 3 nanometers, and now you're going to 2 and maybe even 1 cutting edge. You really need, the failure rate goes up. You really need the leading edge testing materials to say, well, are we making these things and are they working? Because if they start failing on you, supply issues. So KLA are really the leading provider of that information, that stuff. And then Broadcom is sort of is called A6 application specific chips, which again is competing against NVIDIA.
Yeah, yeah, exactly. Brilliant. Okay, thank you very much indeed. We should probably wrap up there because given where we are. But thank you for your time.
Thank you
this morning.
Thanks for listening.
And good luck with it all. Yeah, good. All right. We will be back next week. We've got something a bit different next week. So I'll be doing the news as usual, and then David Batchelor, who most of you won't know yet, but he's our probably newest recruit. He's going to be leading a panel of talking about active ETFs, and we're just looking at how they sort of might fit into a portfolio. So that should be interesting. So have a good weekend, and we will see you next Friday. Thank you.